So elbows up, Canadians. We got the jobs numbers coming out, or actually already came out last week, Friday, reporting about 7,400 jobs being added for the month of April. Now this comes after a decline that we saw in March, negative 33,000 jobs being lost. And before that, we saw February no change. So we see February no change, March negative 33,000, and April a slight increase of 7,400. What does this mean when you look at the whole holistic picture? And what I like to look at is more of the unemployment rate. We're seeing as a whole the unemployment rate steadily increased from its lows of 4.8% from July 2022 to now staggering 6.9% today, right? Basically almost half of the COVID's peak unemployment rate of 14%. This takes us 6.9% takes us all the way to July of 2021. Sorry, no, I'm mistaken about that. I believe it's September of 2021. Yeah. So basically, we're seeing the steady increase from 2022 all the way till now, just where the unemployment rate not skyrocket, but steadily increases. And we're getting Bank of Canada continuing to cut rates. But what happened? I thought cutting rates would solve the issue, would save the day. I thought a lot of realtors and a lot of people out there told me that when rate cuts come in, everything would be fine and the markets would be doing well and the housing market would be skyrocketing. But what we see here is the unemployment rate is now sitting at 6.9%. We're seeing trade wars affect or are soon going to continue to affect Canadians and global markets. Although, yes, we did hear from Trump today and yesterday over the weekend that they've come up with quote unquote deal, okay, where they've just basically lowered the tariffs, the Chinese tariffs down to 30%. But if you include the additional 10% of the worldwide global tariffs, that makes it around 40% total. Now, if it's if that's the case and we're still seeing tariffs and global supply chain being affected, then we can expect also inflation globally to be high up there and also affecting Canada as well. Now, the trade talks are still continuing between Canada and US and nothing has been solidified yet. So therefore you can expect, and a lot of Canadian economists expect, that inflation is expected to be sticky, to be higher, which would affect more Canadians, which would affect the spending in Canada, which would then affect businesses in Canada, which would then cascade into what? Into the unemployment rate rising and job losses happening. And this is how it always starts. Historically, it steadily rises, and then you get the big collapse, the big kahuna, and then boom, you get a big rise in the unemployment rate. It's a slow and steady method. It takes its time. It's like a big shipping container vessel trying to turn in the Pacific Ocean. It takes time to turn that damn ship around. The same thing goes for the economy. Now, with this 90-day pause that Trump has done with China, it may alleviate some temporarily pain, but it doesn't mean that we're out of the woods yet. So the expectation or the what we see here is that we can expect further rate cuts to come, which you might think that's a good thing, but with historically, when you look at economic trends, this basically leads to a disastrous moment where then you lead to the Bank of Canada doing emergency rate cuts because something has broken, right? So a very telling sign. July 2022, 4.8%, we're at 6.9%. And when we break this down further into the into the different age groups, right? So when we look at the unemployment rate based on 15 years and older, that's the 6.9% that we're talking about. But when we break it into the youth of 15 to 24 years old, it's climbed up from January of 10% all the way up to 14%. Okay, that's 15 to 24-year old, but what about the other age group of more in the working class, the core age of 25 years old to 54 years old? What's that at? When you look at historically, it was sitting around the 4% level back in 2022, and it's picked up to about 5.8%. And then the 55-year-old is sitting about 5.3%. Now, I want to go back to the core age of the 25 to 54 years old. That 5.8% is well above the 2017 to 2019 average, which tends to be a little bit above 5%. So we're well above that average. And same goes for the 15 to 24-year-old. The only thing is the 55-year-old is a little bit below that that average there, sitting at 5.3%. So again, we've been seeing trends move more to the upwards, to the right of the graph, and you're seeing more of the core age being affected, which hence why you would expect the Bank of Canada to continue its rate cuts. Not because things are getting better and things are going to go to the moon and blah 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 and let's buy this and buy that. It's because the economy is getting worse off. It's just a matter of time. The cracks are there. You know, keep hammering at the cracks, it's going to break eventually, but it takes time. When we break down employment of the different sectors, what do we see here is that manufacturing in Canada has been hit the hardest. About 30,000 jobs job losses were seen in the month of April. Okay, we have yet to see that further escalate, especially with the trade wars that was started in April. Wholesale and retail trade also negative 26,000. Business building and other support services negative 14,000. Accommodation and food services around 8,500. Healthcare and social assistance negative 7,800. Natural resources negative 7,500. The construction industry negative 1,800. These are all important sectors that are the blood of the economy. The manufacturing industry, the retail industry, the construction industry that helps prop up the economy are all in massive, massive negative territory. Now, the ones that did add jobs were public administration of 37,000 plus, finance, insurance, real estate, rental, leasing plus 23% jobs, information culture of 12,000 jobs, transportation, warehousing of 8,200. Now, this may be just temporarily, right? Because as a lot of these countries and businesses were importing a lot of goods, there's an period of time where they're trying to front run the tariffs by ordering a lot of these things, kind of like the bullwhip effect, ordering a lot of these things, thus hiring a lot of people because they're handling a lot of these shipments. But what's going to happen later, as they slow down on that and they see the demand is decreasing, they're going to start to then lay off those workers, right? So we can see those numbers drastically change. Now, when we look at Canada from a provincial point of view, looking at different provinces, we see that the national average of Canada is 6.9%, but when you break it down, Ontario is 7.8%, right? A big province in Canada. Alberta, 7.1%, and this is the unemployment rate I'm talking about. So 7.8% in Ontario, 7.1% in Alberta, 6% in Quebec. In BC, 6.2%. None of it, 7.8%. Newfoundland being the highest at 9.6%. So if we just look at Ontario and BC, 7.8%, 6.2%, Alberta 7.1%, the oil market, the head of the oil market for Canada, all in super high levels of unemployment rates. And when we break down the major cities like Toronto, it's sitting at 8.6% unemployment rate. Montreal, 7.1% unemployment rate. And Vancouver, 6.3% unemployment rate. So it's happening. It's just taking its time. And eventually, what happens here when you compare the unemployment rate with, let's say, also the US, we are seeing a correlation where Canada's rising and widening the gap, while US is also rising, but not as significantly in comparison of Canada, because US is more resilient to the factors so far. But what we've been seeing since COVID till now, Canada being leading in the rate cuts, in the rate hikes, to then again cutting rates and talking about QE, and US being a neighboring country following behind. They're not following Canada, but following the same monetary practices of Canada, but just later on, right? So my expectation is that we could see Canada being the leading country to first tip into the recession, and then we will see the other factors play out and the spillover effects in US and other countries as well. So I would say it's very important to watch out how Canada plays, how the economy plays out in Canada, because we're seeing the telling signs of unemployment rate move up higher. We're seeing immigrants starting to leave. You're seeing people complain about the higher prices, job losses happening, seeing there's no faith in Canada anymore, right? And with Carney, the new prime minister, definitely, things can be shaken up. But with his history of, being part of the head of the Bank of England, Bank of Canada, and so forth, we can expect that there's more tendency for him to advocate for more pumping and printing of money when the next crash happens, which will thus just bring prices up higher. But we could talk about that on another time when we get to that scenario and point. We're not there yet. We first need to see the plunge, the crash, the event happen for the money printer to go burr. But until then, here's your telling sign: job market is getting worse off. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video. I'll see you guys around. Cheers, and bye.